The Golden Surge, unraveling the forces propelling gold demand in 2025. Imagine for a moment a world where the ancient gleam of gold no longer whispers of forgotten empires, but shouts across global markets, commanding prices that shatter records and reshape economies. As of November 19, 2025, gold hovers near $4,070 per ounce, a staggering 42% leap from the start of the year, the strongest annual gain since the inflationary tempests of the late 1970s. This is no mere fluctuation. It is a seismic shift in demand, where investors, nations, and industries alike are reaching for the yellow metal as if it were the last lifeboat in a storm of uncertainty. But what hidden currents have converged to create this torrent? Let us peel back the layers, question by question, to uncover not just the what of gold's ascent, but the profound why that reveals deeper truths about our fragile global order. Consider first the specter of geopolitical unrest, that ever-present shadow which has long cast gold as humanity's ultimate refuge. Why, in a year marked by escalating tensions, from US-China trade frictions and tariff threats to conflicts rippling through the Middle East and Eastern Europe, have world leaders and investors turned to bullion with such fervor? The World Bank's Commodity Markets Outlook for October 2025 paints a vivid picture. Heightened risks have ignited safe haven demand, propelling gold's rally amid broader economic anxieties. Echoing this, J.P. Morgan Research notes that trade uncertainties and policy volatility under renewed U.S. tariff regimes have funneled an estimated 710 tons of quarterly demand from central banks and investors alone. Pause here. If gold's allure stems from its immunity to sanctions or seizure, unlike frozen dollar reserves, as seen in Russia's 2022 plight, does this surge not signal a quiet rebellion against the dollar's dominion? Indeed, as empires clash, gold emerges not as relic, but as rebel, its demand swelling by 10% year-over-year in the first 3 quarters, per the World Bank, as portfolios seek ballast against the gales of war and diplomacy's failures. Yet, what of the guardians of global finance themselves? Why have central banks, those stoic stewards of stability, transformed from occasional dabblers into voracious hoarders, devouring over 800 tons of gold in 2025 alone, and positioning for a 4th consecutive year above the 1,000-ton threshold? Metals Focus, in its June 2025 report, forecasts this relentless pace as institutions diversify away from dollar-denominated assets, a trend accelerated by de-dollarization whispers from Beijing to Brasilia. China's People's Bank, for instance, has quietly amassed holdings nearing 2,300 tons by mid-year, often underreported to maintain strategic ambiguity, a tactic that not only fortifies reserves but sets a price floor for the market, as Apollo's Torsten Slock observes, spurring private investors to follow suit. Reflect on this. With 95% of surveyed central bankers planning further accumulation, per the World Gold Council's 2025 survey, and buyers like Poland, Kazakhstan, and emerging players such as Brazil and Guatemala adding 39 tons in September alone, are we witnessing the dawn of a multipolar monetary era? This institutional appetite, twice the 2015-2019 average, now claims nearly 25% of total demand, turning gold from a speculative sideshow into a cornerstone of sovereign strategy. Now turn your gaze to the retail trenches, where everyday savers and high-net-worth titans alike grapple with eroding trust in fiat currencies. In an age of persistent inflation, hovering at 2.3% in the US, above the Fed's target, and fears of debasement from unchecked deficits, why do gold-backed exchange-traded funds, ETFs, report record inflows of $37 billion year-to-date, with North American funds alone absorbing 137 tons in Q3? The CME Group's analysis underscores this flight to tangibles. Even as interest rates defy tradition by remaining elevated, gold's inverse dance with yields has faltered, buoyed instead by inflation hedges and a weakening dollar. China's household frenzy amplifies the chorus, with Shanghai Gold Exchange withdrawals hitting 118 tons in September amid US trade jitters, blending cultural affinity for gold with modern arbitrage plays. And in India, where festive weddings propel $14.7 billion in October imports alone, does this not illustrate gold's dual role as heirloom and hedge, driving bar and coin demand to its strongest first half since 2013? Such fervor begs the question: if Western ETFs and Eastern vaults alike are swelling, is gold not merely surviving inflation, but thriving as the antidote to a world where paper promises increasingly ring hollow? Lurking beneath these tides is a subtler undercurrent: industrial hunger, where gold's conductivity fuels the green revolution even as prices soar. Why then has technology demand held firm despite US tariffs crimping supply chains? The World Gold Council's Q3 2025 Trends Report reveals fractional resilience, offset by AI-driven electronics, but tempered by cost pressures. Yet overall, this sector underscores gold's evolution from mere store of value to enabler of tomorrow's tech. Coupled with subdued recycling, down 1% as holders await peaks, and steady mine output from Mexico to Ghana, supply strains only amplify the imbalance, with demand outpacing output by 25–30% annually. What does this scarcity portend? A structural bull market, as Van Eck posits, where de-dollarization and ETF revivals forge enduring strength. As 2025 draws to a close, gold's surge invites us to ponder: in chasing this eternal metal, are we merely reacting to chaos or proactively forging a more resilient future? With forecasts eyeing $4,000 by mid-2026 from HSBC and beyond, the rally's momentum, fueled by fear, strategy, and necessity, suggests the ascent is far from over. Yet true wisdom lies not in hoarding bars, but in questioning the forces that make them indispensable. In a world adrift, gold does not save us. It mirrors our deepest uncertainties, urging us to build anchors of our own. Please like and subscribe, and catch you on the next one.